Let's get one thing straight. The Calgary real estate market hasn't crashed, but it's definitely changed. If you've been waiting for a sign that the madness is over, or you're sitting on the sidelines hoping for a pullback, well, this video is your roadmap. This is the first time in over 3 years where we're seeing signs of a cooling Calgary real estate market. And if you know how to play the market, it could be a very smart time to make a move. All right, let's dive into the numbers, because when we look at these stats, Calgary home sales have dropped 20% for May when we're looking at year-over-year stats. That's a 3.5-year low in monthly demand. But here's the kicker. Inventory is up 100% year over year. And no, that wasn't a typo. Last year, we had so few listings that the average home barely made it through a weekend without multiple offers. Now, inventory is building. Buyers have options, and the frenzy, it's cooled off. But, and there is a big but.
And would you stop taking pictures of yourself? Your sister's going to jail.
Don't mistake cooling for crashing, because even with this surge in listings, Calgary is still healthier than most major markets in Canada. The sales to new listing ratio sits at 55%. That's miles above Toronto's 28%, Vancouver's 34%, and still within boundaries of a balanced market. But what's really causing this slowdown? A lot of people are blaming interest rates, and yes, Bank of Canada holding firm at 5% isn't helping affordability, but here's the data that most people miss. The monthly mortgage payment on a typical Canadian home is now back to $2,600 a month, and that's the lowest that we've seen since May of 2022. And if we get even a 25 basis point cut in June, that drops that number again. The bond market is pricing in a 50-50 chance right now, but here's the point. Affordability is improving slowly, and that alone is setting the stage for a bit of a comeback. Consumer confidence is the real story. According to the Nanos Confidence Index, we're seeing early signs of a V-shaped recovery in consumer sentiment. Both the general index and real estate specific confidence are trending up. Translation, buyers aren't broke, they're just hesitant. This is the classic pause psychology. Everybody's waiting for confirmation that the worst is over, and if confidence continues building, we could see a 15 to 20% boost in transaction volume over the next 60 to 90 days across Canada. The key word there is we could. So is this the opportunity that everyone's been waiting for? Well, let me answer that with a story. A client of mine, let's call him not Tyler, wanted to buy a home in Auburn Bay last year. Detached home, 3 bedrooms, need a garage. He lost 2 bidding wars. We walked away, pretty discouraged, came back last week. We found him nearly the identical home for $19,000 less than what a similar home sold for earlier this year. And guess what? He actually got to put in an offer with conditions, financing and inspection, no pressure, no bully offer deadlines, and just calm, reasonable negotiating.
Yes, the negotiator.
Don't get me wrong, we still see multiple offers and saw several of our own listings sell multiple offers just this month, but those homes are usually mature or highly desirable communities and typically present better than most others in the same area. That's what's happening right now, and for buyers who are ready, it's a breath of fresh air. All right, if you've made it this far, you clearly are into this content, so do me a favor. Hit the like button, helps more people see this. And if you want more straight to the point real estate insights without the fluff, make sure to subscribe. I drop videos like this often, very often. I'd actually drop it more if I had more subscribers. So thank you for subbing. A quick breakdown of what we're seeing in our market right now. For detached home, the benchmark price is up almost 2.5% year over year, but we are starting to see inventory creep up. So if you're thinking about listing your home, make sure that you're listing it properly the first time. For the semi-detached market, we are seeing sales down almost 30% year over year. I do think that pricing outpaced demand, and now we're seeing a bit of a pullback, so very vulnerable segment. For row homes, I am absolutely shocked. Inventory is up over 165% year over year. They're still highly sought after by first-time home buyers, but with inventory spiking this much, we are starting to see prices come down drastically in some. For apartments, active inventory is up over 90%, and quick spoiler alert, a lot more is coming, but that's a full story on its own. A quick flashback. In the 1970s, Canada introduced the Multi-Unit Residential Building Tax Deduction, or MURB. It let wealthy investors deduct rental construction losses against unrelated income. Well, guess what? There's talks of bringing it back. If the MURB program returns, we'll see a new wave of investors. not chasing cash flow, but looking for tax shelters. These aren't your average landlords. They're high-income professionals who can afford to take a loss if it saves them big on taxes. If you're an existing landlord or thinking about becoming one, keep an eye on this because it could flood the market with new purpose-built rentals. That's good for renters, and it's also good for long-term affordability, but it could hurt resale values of condos and townhomes if you're competing against brand new, tax incentivized inventory. So should you be buying right now? Well, it depends, but this is what I'm telling my clients. If you're looking for a primary residence, this is the best environment that we've had since early 2021. You can breathe, you can negotiate, and for the most part, you're not racing against 17 other offers. If you're an investor, you need to be focused on suited homes, infill teardown opportunities, or products under $600K to cash flow or break even. If you're a seller, pricing is everything. You have to be strategic. Overprice and you'll sit. Price at the market and you'll move. Homes that show well and are priced right are still going to sell within the first 10 days. And if you're upgrading or downsizing, you finally have options. The gap between sell price and buy price has shrunk, and that's your window. Let me level with you. Some of the slowdown we're seeing, it's a realtor confidence crisis. When deals slow down, marketing tightens up. Agents start panicking and telling their clients, just drop the price, drop it again. And that can make things look a lot worse than they really are. But here's the truth. The sky isn't falling, it's balancing. And the agents who understand how to market, price, and negotiate, not just list and pray, will thrive in this market. If rates stay where they are, expect a pretty steady build of inventory throughout summer, and that's gonna put downward pressure on prices in those higher segments, especially over $900,000 or detached homes in oversupplied neighborhoods. If we get a rate cut, watch for the lower end of the market to absolutely ignite. First-time homebuyers are positioned to jump back into the market the moment that they feel confident, and confidence is brewing. Just remember, the last time that monthly payments were this low, sales were 52% higher than they are now. So we know that the demand is there. We're in the eye of the storm. Not because chaos is coming, but because there's a calm before the return of activity. Smart buyers will take advantage of this breathing room. Smart sellers will price strategically and still move properties. And smart investors will look for long-term plays, not short-term flips. If you want to make a move and make it smart, get in touch. My team and I are here analyzing these numbers every single day, and we don't follow the hype. We follow the data. This isn't 2021. This is not 2023. This is 2025, and that means something completely different.